All right, I'll say it. I used a scary thumbnail to get you to click. Because if I titled today's session as Measured Discussion on Market Risk, you wouldn't be here. And what I'm about to say actually matters. A lot of you ask often, why do I sound so bearish? I'm not bearish. I'm a risk manager. And there's a difference. In my career, it started in the dot com bubble. I watched friends get wiped out. I watched clients go to zero. I learned early that making money is optional, surviving is not. I've had members with me for nearly 2 decades, not because I predicted every rally, but because when things break, we don't. I was there through the financial crisis, through every major volatile event since. And the reason people stay with me is simple: protecting capital matters as much as compounding it. And this is why I started big picture trading, to help people understand when risks are high. And it's what I want to do for you here today. So if the tone feels urgent, it's because I've seen this movie before. I've been saying for weeks that the stock market has been on a knife's edge. And now I believe we've actually crossed that line. So let's dive into this. Now, there's two things I'm going to focus on with you here: credit markets and tech stocks. All right. Now, back in October, JP Morgan CEO Jamie Dimon warned that, like cockroaches, when it comes to bad loans, if there's one, more are likely to emerge, especially if the economy weakens. Well, over the last few weeks, we've seen Blue Owl, a private credit capital business, get rocked, which has now led to investors starting to pull serious money out of private credit funds, including Blackstone's BCRED fund, which is the largest private credit fund in the world. In just one quarter, nearly 8% of the fund's shares were redeemed. Well, that's well above the typical limit. Now, Blackstone is meeting those withdrawals, but the bigger issue is confidence. A lot of these funds are heavily exposed to software companies, and with growing concerns about the AI disruption and slowing growth, investors are getting nervous about credit quality and valuations. So this isn't about one fund blowing up. It's about rising redemption pressure across the entire private credit industry, which is forcing markets to confront liquidity risks, default risks, and whether these smooth returns of the past few years were masking the real underlying fragility. Now, I want to quickly show you a chart that I have at Big Picture Trading, which I talk to my members about all the time. It's this idea that almost all stress escalation starts with accounting stresses. Accounting stressors sound boring, but it's the way the market actually starts to crack. Losses start getting recognized, mark to market things are repriced, and suddenly all these balance sheets don't look the way they did a few years earlier, drawing concerns. Then it leads to funding stresses, where we in fact have been for the last 2 weeks, and a lot of liquidity issues happen and develop this way. Now, the byproduct is the outlet becomes currency stresses. And what we've seen in the last 2 days was a substantial breakout in the US dollar, which on an intermarket basis is something that we have seen in the past once credit stresses have emerged. So there's a lot of red flags on this that we need to talk about and see what is going on. All right. So the S&P is down 100 points, but I actually want to first talk about these credit risks. Now, first of all, I want to specifically speak to this Franklin Senior Loan ETF. You've seen me on this channel talk about this before, but this is not, this is crazy what we're witnessing. We are literally seeing that the senior loan ETF is actually crashing well below Liberation Day lows. This is just showing that credit stresses are there, and everyone is grabbing at capital and cash any way they can and liquidating where the fragility is. The fact is that when the markets tried to rally over the last week or two, this thing could not budge off of its lows. This is just demonstrating exactly how much stress is developing. Now, we have seen some breakdown in the junk bonds. Now, this gap down is not as bad as it looks. There was an ex-dividend date that caused that to actually break a little bit. But the fact that junk bonds are starting to feel the stress is important. Similarly, we saw as well on a dividend redemption a little bit of a gap down, but definitely selling pressure finally starting to come in on investment grade bonds. But it is actually the government bonds that have actually started to break. First of all, what I want to highlight is that we're seeing, for instance, selling already emerging in SOFR futures, coming off there, raising a little bit of interest rates. But when you're really breaking it down, you're looking at everything from the 2-year note reversing off of its highs, the 10-year bond reversing off its highs, the 30-year bond reversing off its highs. The bond markets have woken up and things are cracking. Now, bond markets are seeing liquidity. This is where the credit risks have come. But now, from an intermarket basis, what I actually care about is when do other markets start to care? And something happened yesterday that it led to some further follow through today, which was a legitimate US dollar breakout. Now, the key here is that we were consolidating on the dollar in a bear trend down along the fib zone, continuing to fail below the 50-day moving average. At that moment, even late last week, there was plenty of arguments to be made that the US dollar was in a position to potentially continue its breakdown on the downside. And that simply never emerged. And the moment these credit stresses happened, suddenly the US dollar rises. Why? Well, when there is credit cracks, people go for quality, and the scarcity is liquidity and cash. And so therefore the dollar tends to rally in those periods. So the fact that we're seeing on an intermarket basis the dollar rallying in the last 2 days at the same time as these credit markets are stressing, you can't ignore it. Okay, so now I want to move to the next key thing is that what just happened in the Kospi. Okay, so now we've been talking about the Nasdaq, we've been talking about Nvidia, but I want to talk about the South Korean index, particularly two stocks that make up almost half of the entire South Korean market capitalization, which is Samsung and SK Hynix, which have become the bubble center point of this AI boom. As everything chilled out in the United States, everyone piled into this South Korean index. I made a bold call when I was on the Market Huddle, the podcast that I co-host with Kevin Muir on Friday, and then I had an episode, and I basically made the call that when the Kospi tops and reverses, that will mark the top of the market. And this morning we got our big reversal in the Kospi. So I want to quickly show one chart of just how crazy this bubble was. Now, first of all, we had a tripling of implied volatilities on the way up in the Kospi. Not only that, the ETF volume for EWI, which is the Kospi ETF, basically went from $500 million a day for years, decades, to suddenly $6 billion of notional volume coming in. This is insane. It suddenly became the epicenter of everybody's attention on what was working. So it was so crazy that, like I was saying, the implied volatilities actually doubled and tripled on the way up. Normally, you see the VIX spike during market crashes. In the case of the Kospi, it was actually crashing higher with implied volatilities skyrocketing on the way up. The point being here is we got this peak to trough decline of about 9% since Friday's peak to this morning. Yesterday was a market holiday in South Korea, so this is just this morning's price action in South Korea. Now, if this was one day doesn't make a new trend, but it is magnitude is very reminiscent of the start of the silver drop after the silver blow off on the upside. And if this was in fact the peak of the Kospi, it is going to mean that this was the peak in SK Hynix. It was the peak in Samsung, and it is going to be where money is going to be drawn out of this. Now, at the same time that all of this is happening, we are seeing direct stresses in the NASDAQ this morning, down 500 points on the NASDAQ 100 futures, down 2%. Now, have we officially broken to lower lows on this in the S&P? Not yet, but this is why I'm out here having this conversation with you, because we haven't yet fallen off the edge of the cliff, but the probabilities here are more and more likely that we're about to see the break. Now, what is it that's the warning? Well, first of all, we had a technical double top along its high, and at the same time, a very clear failure at the 50-day moving average and at the 61.8 retrace. With this flagging formation failure, it is very likely here that the next leg is a breakdown in this NASDAQ. This is coming at a time when the MAG 7s are indicating an open right along the previous low. So you have a scenario at this moment where the MAG 7s could very well break down. Early morning anticipation is NVIDIA opens at $177, giving back yesterday's attempted rally that failed well below its 50-day moving average. If this ends up being one big head and shoulders kind of topping formation on NVIDIA, a break of that neckline, you can see how all of these things are lining up. Now, the one thing that we are seeing here is this morning a legitimate spike in volatility. We were at one point trading at 27% implied volatility. This is something you can't ignore. What's happening is people are desperately reaching for that put insurance to protect their portfolios, and they're willing to pay up to get it. And we are now approaching, obviously, the highs of October and November. But look at that Liberation Day spike. The bottom line here is if a break to lower lows in these markets is accompanied by a break on the volatility index north of those previous highs, then things are going to get really messy. And the likelihood that it can all happen today is very real. And so you cannot ignore these things. These are accompanied by the fact that gold's off of its highs by $140, silver's down almost $7, crude oil's ripping another $5 as the Strait of Hormuz has clearly been at least temporarily shut down, creating all sorts of concerns on the oil markets. And so a lot of these things are high tension, high stress. There's liquidity issues, there's credit stresses, and now you're seeing the currencies confirming it. A lot of these things are all lining up. None of these are short-term bullish. And this is why I wanted to come on and share this with all of you to talk about this. Now, what I do here and what I'll be doing in an hour or so, actually just a little bit more than an hour, I'm going to be online at Big Picture Trading, and we're doing a special session today, particularly on this topic. Now, I come on here on YouTube and I share with you a lot of this information, but it is during the Where's the Trade where we take these ideas and this information and we actually convert them into trades. And so we've been positioning for this, and we have to talk about with members today what we're actually going to do and how we're going to deal with all of this. Remember, I'm a risk manager first. This is not about being bearish. This is about capital preservation and being defensive when you need to, because what you need to be able to do is buffer the risks in these markets and make your portfolio resilient so that when this kind of volatility happens, you weather it very well and you're on the other side to make a shitload of money when the market subsequently rallies. And this is where we're right now at a fragile moment. Things can get very messy in here, and we're going to be in the Where's the Trade session talking about that. So those of you, like, I can't think of a better time to actually try the 14-day free trial. I mean, all of you hear me on every single one of these videos mention it, But if there was ever a time to actually kick the tires on a no credit card required 14-day free trial and actually see what we're doing and how we're calling these terms, this is a great time to do it. So you can go to bigpicturetrading.com and do the 14 trial there, or click on the link in the chat below, and you'll at 9:45 Eastern time, I'm going to be starting the Where's the Trade with members, where we're going to go deeper in on this. So if you all want to join me, you're welcome to click on those links, and we'll see you there. Otherwise, if you don't, I'll give you all an update here tomorrow, and we'll see how this all played out. Anyway, that's where we're going to wrap it up. Have a good trading day. Navigate these choppy waters carefully here, everyone, and have a good trading day. Cheers.